talking about today's the latest benchmark diesel price, and it continues its slide downwards. John, were you surprised or really not now that we're continuing to see this slide?
No, not surprised at all, because the futures market has been way down. The retail market's catching up to earlier declines in the futures market, not even catching up to the ones of the last few days. So the market, the futures market, hit a high like last Tuesday when there was some anticipation of significant cuts that were going to be agreed upon by the OPEC Plus group, which met virtually on Thursday. That was so they were at about $290 dollars per gallon. $290 per gallon. And since that time, the OPEC Plus meeting came out with an agreement to quote unquote cut that a lot of the market just doesn't really think is going to do much of anything. And so the price is down I think 30 cents since that time. So it's a significant drop. So no, I absolutely expected the DOE number to decline. It also tracked the declines that we have in Sonar in our DTS.USA data series, which showed about a decrease of 5 cents. And the decline yesterday, I think, was 5.4 cents. We're down 9 of 11 weeks, and we're down. I should have these numbers right in front of me, but we're down a lot. Okay, diesel is a lot cheaper than it was, and it's not that from its high in June of 2022. It's down like $1.70. So diesel has really retreated.
And there was at one point in time where the national average was over $5 a gallon, right? And I know a lot of drivers were sitting here saying, I just literally cannot afford to run right now because of these diesel prices. And we're still continuing to see that really strong decline in the freight market. But the good news is that we are also seeing those declines in the fuel markets. Does this open up a little bit more of an opportunity for maybe those who had parked their trucks to say, okay, maybe this is a little bit more profitable, a little bit more affordable, and I can jump back in?
Well, you wonder if rates don't really go up significantly as this decline in diesel, which is nice, good to have. I mean, is that enough to make it suddenly profitable? I wonder about that. So I think you'd still have to have an increase in rates to make it all worthwhile again for those who park their trucks.
So, of course, going back to that OPEC Plus decision, what now does the kind of long-term fallout look from that decision to make those little cuts?
Well, so the headline number was they cut 2.2 million barrels a day, but that's not really what they did. First of all, and they included in that 2.2 million barrels, they included the million barrel a day cut that Saudi Arabia implemented in June, I believe it was, and that's continuing. So that's not a change. They also have a cut of 500,000 barrels per day from Russia in exports, not necessarily production, in exports, which also is in place. So that brings you back down around 700,000 barrels a day of new cuts. If that were to be implemented, that would be significant. However, the cuts are also measured in reduction in quotas from a lot of countries that weren't even producing their quotas to begin with. So those aren't real cuts. The market this year was definitely in an imbalance between supply and demand, but with supply trailing, actually for most of the years going in, supply trailing the increase in demand, which was healthy this year, over 2 million barrels a day. The models for next year do not show demand increasing even 1 million barrels a day, but show supply increasing like well over 1 million barrels a day. So that's what OPEC Plus was looking at. They were looking at an imbalance going into next year that was definitely very bearish. So they came out with these cuts. We'll have to see. We'll have to see whether they actually are implemented and whether they have any impact. But I would say that the market right now is very skeptical of them, and that's why you've seen declines now in the market. I mean, it's down this morning. You've seen declines 5 days in a row. Some of them significant. Brent, the world crude benchmark, is down as of yesterday was down like $5 a barrel from where it was last Tuesday.
So, John, let's move to the other two little nuggets that are kind of tucked into the bottom of your diesel price story this morning. News from the Department of Energy about filling the strategic petroleum reserves back up. What does that mean for us?
Well, it's bullish, obviously. I mean, that's a new buyer on the market that wouldn't have been there on a normal day. So the SPR was being drawn down over the last year and a half or more by two reasons. First of all, everybody knows about the Biden administration's plan to tap the SPR as a result of the world kind of turning its back on Russia. Russia was able to continue to produce, but in the early days after the invasion of Ukraine, a lot of companies didn't want to deal with them. So that the fear here was that was going to tighten supplies. That process is over. For several years now, the SPR had really gotten bigger than it needed to given the decline in U.S. imports because of the rise in in U.S. production. The SPR as a percent of imports had just soared. So Congress, not just under the Biden administration, but also under the Trump administration, had agreed to sell some oil out of the SPR, essentially as a budget measure. That is continuing. I don't know the schedule. That is continuing. But what the Biden administration is doing is they're saying they're going to go back in and they could buy as much as 3 million barrels of oil a month to refill the SPR. That's about 100,000 barrels a day. That's significant, not overly significant. It's obviously a bullish factor, but I don't know that it's a bullish factor to really kind of change the fundamentals of the market, which right now point down.
So then the other little nugget that was in there, natural gas prices. And as we're moving into kind of the slow start for winter for the majority of the country, what does that look like?
Well, basically looks like this. I don't know if that my fingers help. From where it was like 3 months ago, it went up pretty good and then has come down and really retraced all of the gains from earlier. We went into the world went into the winter with pretty good inventories, natural gas in stocks, and we're 5 days into December, or is it 5 days into December? The forecast for much of the U.S. has been continuing relatively warm weather. Remember that these are already sort of January prices that are being traded on the CME. And right now, the market just doesn't see any reason to be concerned. You'd have to have a pretty radical change in the weather forecast, I think, to get a weather-related boost in natural gas. I mean, this as a meteorologist that while the 10 and 14-day forecast might be off on precipitation, they're usually pretty good on temperature. And right now, there's nothing out there on these long-range forecasts that show any kind of a cold snap. So by that point, you're talking about being into the 15th, 16th, 17th of December, and you haven't had much of a winter. So where it comes back to affecting diesel is that diesel and natural gas in certain applications can be swapped for each other. Last year, there was when natural gas was just insanely high, there was a lot of concern that some applications would switch to diesel, and that would boost diesel. Well, nobody's going to be switching natural gas out for diesel right now, given the price of natural gas. So that's why it's a positive for diesel consumers.
And it's going to be interesting to watch, especially because, as you mentioned, that long-range forecast looking at least decently right at average for kind of these next 10 to 14 days. John, thanks for joining us this morning. And, of course, we can catch Drilling Deep later on this week, so we'll see you then.
Okay, thank you.